Hello, everyone. I'm Adam Blair. I'm the editor of Retail Touchpoints. I'm very happy to have Charlie O'Shea, a senior retail analyst at Moody's, to join me for this conversation for Retail Reset. The goal with these conversations is to provide a curated virtual forum for retail executives to help them map their post-coronavirus recovery strategies. Today, we're going to be digging into some of the financial aspects of the ways businesses are reinventing themselves and also the impact so far of COVID-19. Charlie, thanks so much for taking the time to talk with me in Retail Touchpoints.
Thanks for having me, Adam.
Okay, well, let's dive right in. In your work at Moody's, you cover a number of the retailers that have been deemed essential: Walmart, Target, Whole Foods, BJ's, Costco, et cetera. It might seem an obvious question, but have they been able to take advantage of their position during this unique time?
That's kind of hard to say when you talk about taking advantage. I think that, they're all focused on providing services to the various communities in which they're operating, and they view themselves as, stewards of those communities. So I think they're benefiting in a way that they're getting shoppers that they normally wouldn't get because they're open. I think when you look at what's happening to Target, which is, Target and Costco, really, Costco called it out earlier, but Target was more focused on it because it hits them harder, is that the mix of what they're selling is creating some profitability issues. They're selling a lot more low margin stuff. They're doing a lot more, online, which is higher cost. Even an in-store pickup, curbside delivery has more cost than an in-store sale. So they're seeing, robust sales, but the mix is driving margins down. So, again, they're out there, they're open, they have a big advantage over a retailer that isn't open because they've got the store option. But there are going to be some challenges in certain categories for both the guys that are open as well as the ones that are closed once they're able to open.
What would you say have been some of the key elements of these retailer strategies with regard to basics like store operations, digital commerce, discounting or promotions, customer communications? Do you see them with specific offerings or capabilities that they're using to differentiate competitively?
I think so. That's nuanced. But I think what everyone has done is they've been very upfront. And I think Walmart was the first to do it back in the analyst meeting on February 18th here in New York. They talked about Corona and they talked about what they felt their role should be. And they likened it, and this is a bad example, but they likened it to how they operate during a hurricane, where they do everything in their power to keep the stores open because the communities need them. They're focused on safety of employees, safety on shoppers, but they want to do everything they possibly can to stay open. And I think that's what you're seeing with these guys. Early, they were open. Now you started to see, some softer hours, reduced hours, reduced store traffic, requiring masks in stores. They're seeing heavier buy online pickup, obviously, seeing heavier online sales. And they're seeing the mixes. The biggest challenge for them has been in stocks of essentials. And that would include the grocery stores. You can walk into one of these stores and not find a roll of paper towels to save your life. I don't know where the wipes all went. Those have been out of stock for an awfully long time. So they've been, again, trying to play to the needs of the community. I don't think anyone's too worried about selling non-essentials at this point. They'd like to make those sales, but I think the focus has really been safety for employees and shoppers. You've seen, limited hours or limiting hours so that they can clean the stores more robustly and deeper than they ever have. There's tape everywhere on the floors in the retail stores, keeping social distance in one-way aisles, cleaning the carts, spraying the carts, offering wipes to wipe down the carts. There's all sorts of things going on. The plexiglass at the checkout to protect both the shopper and the checkout clerk. They're doing all of these, kind of safety measures. And if you go on any of the websites, right at the top of the page for virtually everyone is what they're doing for COVID-19. And I think they all recognize that, again, they have a service to provide to the community. Yes, they're retailers. Yes, they're out to make money. But in an environment like this, their primary focus is on safety and providing the communities that they're serving with the products that they really need.
Charles, I wanted to come back to Target. I know you had mentioned them, and they made a splash announcing that they had more than doubled in digital sales, as well as the impact on their store operations. But you provided some comments that we used about that their margins or profitability could still be negatively affected, probably have been, by these additional fulfillment and delivery costs. I'm wondering if COVID-19 could end up being unprofitable, or I guess extra costs, even for these busy essential retailers. Do you see that as something that could happen to other retailers as well?
Absolutely. I think what we've seen here is, with the explosion online, you've really had a pull forward of demand. And I don't think any retailer expected, 200% increases in online sales, and they weren't scaled for that yet. So they're trying to throw things at it to satisfy and service the customer, and it's going to cost them more than they anticipated. You can't go from, I use the analogy, it's almost like trying to drink water out of a fire hose. You've seen such an onslaught of demand online and for pickup and everything else, and their costs were set up so that they could handle some percentage of that. But you've seen a flip-flop here, where you've seen, store sales, or, in Target's case, I think they announced, comps were up mid to high single digits, but the online sales have exploded. And that's obviously a higher cost sale in the best of situations. But in the current situation, your costs are going to be higher incrementally. And right. I've never been in the camp that I've worried too much about whether the online sale itself is quote unquote profitable. I don't think that has mattered, and I really don't think it matters now. I think you just have to get the capability, and at some point, those curves cross, and you start to generate infinitely more profitability from an online sale. But in the current environment, that's not what we're going to focus on. I mean, we're looking at it. We obviously focus on profitability, but we understand that for all these retailers, we're in a new world right now. And, the old measures aren't going to matter for a bit. And we just really need to focus on what they're doing, how well they're doing it, and what they're going to learn from it. Because, again, there's a cost now, but over time, the knowledge that you've gained and the efficiencies that you may be able to generate going forward with the melding of online and brick and mortar is something that's really going to be beneficial, I think, over the long haul.
Well, and that leads right into my next question about a longer term view. Certainly these companies are seeing perhaps digital customers that never use their digital, or maybe only used it once. What kinds of strategies do you think the leading retailers are going to use to hold on to these digital customers, and maybe even gain some market share against Amazon or some of the other really big players?
Well, I think what we're seeing, and I also cover Amazon, I think what we're seeing is the fact that the value that we've seen in the store bases, when you combine it with an online and you use it to leverage an online business, is really coming to the fore right now, where, again, buy online, pick up in store, curbside, whatever you want to call it, that's exploding. And that provides same day availability. We know Amazon is spending a lot of money, hiring a lot of people, trying to keep up with the surge in demand. They've had to delay some shipments on non-essential products in order to be able to ship essential products. The brick and mortar guys, Walmart's got 5,400 stores in the US when you count Sam's and Neighborhood Markets. Those are all pickup points. They're all potential shipping points. And they provide the consumer with access to product when they want it and how they want it. And I think that's something that we've been seeing over the last several years. We cited it in something we wrote, 7.5 years ago, where we thought that the brick and mortar guys would, once they've devoted resources to online, would be able to use those stores as an asset. They're assets for a reason. And I think that's what you're going to see going forward, that customers will recognize, those that haven't will realize that there is another option out there to get product quickly. And maybe you have to get in a car or pick some mode of transportation to go to a store. There's some stats out there that I think it's 90 or 95% of the U.S. population lives within 5 or 10 miles of a Walmart store, for instance. That's compelling information for a retailer. They know that, they're 15 or 20 minutes away from most of their shoppers. And being able to offer the pickup component, I think, is meaningful. We were already seeing it heading into this. We're seeing it explode now. And I think you'll see that there will be consumers that said, hey, this really isn't as hard as I thought it would be. And there's something compelling, I guess, about, being able to drive up to a retail store and just have somebody put the stuff in your trunk and then you drive home. It's a little bit higher cost for the retailer, but the basket sizes tend to be a little bit higher. And yes, you lose the impulse buy at the checkout or, on an end cap, but net, I think they come out okay.
Yeah, and it might make a compelling, not argument, but draw against Amazon Prime, which of course its strength has been about bundling and convenience and kind of the habit forming aspect of it.
Right.
I'm wondering if you see, the actions that Walmart, Target, Costco, et cetera, these essential retailers. Do you think it's going to have an impact on the broader retail market, and especially in terms of their financial positions? I mean, is what they do going to affect the kinds of investments that other retailers make? And
for a lot of other retailers, that ship already sailed. We've been saying, our team for years now has been saying that, there's a barbell, whatever analogy you want to use, the weak versus the strong versus the weak, et cetera. And it's been very correlated to our ratings. And the better balance sheets obviously have advantages. And we're seeing that now where, you've got several retailers that, they've proactively issued debt, but it doesn't look like they're going to need it. And they've been able to make the investments. If you take a retailer that's got high leverage, they don't have the resources to throw at technology, online, stores, happy employees, maybe making price investments and dealing with a punishing debt load. The guys at the top of the food chain, the higher rated investment grade retailers have balance sheets. They're not worried about the next interest payment on their debt. They've got the ability to invest in stores, to invest in people, to pay, combat pay for employees right now, to attract employees. I mean, Walmart's hired 150, 175,000 new employees, something like that over the last few weeks. Amazon's done the same thing. How many of those people are going to stay in those jobs if the jobs remain? That's an open question. They may find that, that's not such a bad, those aren't such bad positions. I mean, they're good positions for a lot of people. So I think what you'll see is it'll continue, the gap will continue to widen. I mean, we're already seeing it now. I mean, we've seen, multiple downgrades from, investment grade retailers have gone into high yield, and, some have been downgraded further into high yield. And I think that the guys that have had the ability, we use the term financial flexibility, which is broad, but, it is what it is. And that's what they've been able to, they've had that luxury. They're not carrying heavy debt loads. They've got the ability to invest. I mean, I can remember in October 2015 when Doug McMillon from Walmart made the announcement at the stock exchange at the analyst meeting that they were going to spend the next 3 years investing in various things, people, price, technology, stores, et cetera. And the equity markets revolted. The stock went down 10% in a couple hours. But look what's happened since then. Even ahead of this, Walmart is running like I've never seen it. I've covered the company for 17 and a half years. They've never been performing as well as they were performing heading into Corona, with the leveraging of the stores, the website, being able to offer all things really to all people. And those are advantages, I think, that are not going to go away once this is over. And in fact, I think they'll be magnified.
Interesting. Well, let's talk a little bit about Amazon. And I'm glad you mentioned that's part of your coverage. I mean, I think everyone's assuming this has been good for their business, good for Amazon's business. You mentioned that they're hiring more people. But I'm wondering if you see any way to more specifically quantify what's happening with Amazon, and like the others are, like the brick and mortar retailers, do they face hidden costs that might affect the margins and profitability and the financial impact of COVID?
Absolutely. I think that with Amazon specifically, you've got AWS, which, I think our forecast for AWS and operating income for 2020 ahead of this, everything is ahead of this, was around 10 billion. And the retail business, because of the costs heading into Corona, to expand delivery capability and increase the speed, Amazon had spent roughly $3.5 billion in the last 3 quarters of 2019 on that initiative. We thought the spending would continue at roughly that pace throughout 2020. So maybe another $4.5 billion in costs, in delivery costs. Amazon, I don't have the math at the tip of my tongue, but I think the spend on shipping for 2019 was like $37 billion, which is a staggering number. And they don't provide you with revenue like they used to. So you don't know what they exactly absorbed. We expected it to be in the high teens, maybe as much as 20 billion in just absorbed shipping costs for consumers. And the Prime membership picks up part of that. And some of the stuff is higher margin, but Amazon's been running at very low margins on the retail side for years. And its shareholders don't mind. What you'll see from Amazon, I think they're going to report tomorrow. I think you're going to see Amazon report just ridiculously explosive sales. And let's see where the costs come out. We had Amazon, again, prior to Corona, globally as a retailer, taking out AWS, just focusing on the non-AWS business, not generating a lot of operating income in Q1. And we'll have to see where the costs come out, because that's the real, for Amazon, they can always sell. The question is, what's that going to do to the cost base, and how are there, there's certainly a surge in delivery costs this quarter. What are they going to be? And how much is that going to eat into profitability? Amazon will face margin pressure differently. I mean, they'll face it on the mix side, because I don't know how many people are buying apparel in this environment anyway. So they'll face on the mix side. They'll be selling lower margin product, a lot of it, like everyone else is. But they also have the surge in delivery costs. The other retailers will have surges in their delivery costs. They'll have payroll expenses that have gone up. We'll just have to see how it plays out. But we did not expect high levels of profitability out of Amazon for Q1.
Well, and let's talk about, you mentioned some of the other retailers that are suffering under, big debt loads or have leverage issues. There were rumors, and it might still happen, that Neiman Marcus and JCPenney might be declaring bankruptcy. Gap is apparently not paying rents. Macy's is looking to build up its cash reserves, I believe, with its real estate as collateral. How widespread do you think the damage is going to be in retail as a whole? And who would you say might be in the best position to emerge in reasonably good shape? Hopefully when there is another side, and the next side of the post-pandemic period.
It's interesting to see how close to the razor a lot of companies were running. And no one models stores closed for 6 weeks. So it's not fair to criticize managements for not being able to kind of navigate through this without any issues. That's just unreasonable at best. I think the companies that are best positioned are the ones that were best positioned heading into this. There were challenges in retail. There were cracks and fissures in some segments showing up for several quarters now. That's been magnified. A lot of those retailers have closed stores. They're throwing everything but the kitchen sink at the issue, trying to preserve liquidity, using curbside pickup, beefing up their online capability, doing everything they possibly can. Promotions are starting to pop. I saw some 70 off today, 60 off with some of the apparel retailers. That behavior is going to continue into Q2 and potentially beyond. But I think that the guys that we would consider to be high quality will certainly be okay. Some of them, depending on the sector, may get beat up more than others. But again, if you have a solid credit profile and you've been able to stay open, you've been able to make the investments, you'll be able to get through this. There's going to be some choppiness, some bumps in the road, and we're going to see some short-term pressure on our credit metrics. But we're trying to look through that for a lot of the higher quality and higher rated companies, because we do realize that there will be some sort of a rebound, and what will they look like when that happens? But clearly there will be a shakeout, and there's a lot of rumors out there. We don't comment on rumors. We wait for the actual facts to happen. It's not that we're not looking at various scenarios across every sector of retail. I mean, I cover the dealers, and we've taken a couple of rating actions there, not substantive, because we don't know yet. We don't know what we don't know. And you start to model various scenarios across retail. And for a lot of retailers, it doesn't take a lot for them to have issues, especially those at the lower end of the rating scale, because they're already challenged. They're already worried about making interest payments and coupon payments on their bonds, and satisfying term loan requirements. And this is not, nobody needed this for a variety of reasons, but for a lot of retailers, this is certainly going to be devastating.
You've kind of answered the next question about how Wall Street or the investment community views retail, maybe as an entire market. And I know sometimes that's not fair, since, as you pointed out, different segments, different verticals are going to be affected differently by this. But I'd ask you to take that big picture look and say, do you see this as having long-term effects on, I guess, the investor community and how retail is viewed and seen? Will it not be seen as a strong investment going forward?
I think, and don't forget, I'm on the credit side of the equation. I think what you'll see is what you had been seeing ahead of this, magnified by a lot. You'll see, again, the flight to quality. Who are the survivors? And one of the things that we focus a lot on when we're rating companies at the lower end of the rating scale is, do they need to exist? If they go away, is the market really going to miss them? I covered Radio Shack for years, and Radio Shack, was viewed as one of those pillars of U.S. retail. If you needed a whatchamacallit or thingamajig, that was the place to go. And then Radio Shack wasn't there anymore and isn't there anymore. But those sales get absorbed. Toys R Us, the sales get absorbed somewhere. And in a lot of cases, we're going to see that right now. This is going to be, once we come out of the back end of this is going to be a point of demarcation for a lot of retailers. They're going to have to, and their owners, if it's a private equity sponsor, they're going to have to figure out what's the survivability for this company, even after we get through this. And if they're still standing, and a lot of them won't be, but if they're still standing, how long can they stand? And are they going to need more investment? And pretty much everybody is going to need more investment on the back end of this. They're going to realize that, what we had, we thought it was working okay. And again, this is a tough environment to really critique anybody, and I don't want to even come close to doing that. But what are we going to do next? Is there another arrow in the quiver that we can use to maybe strengthen our position on the back end of this? And I think you're going to find that a lot of retailers are tapped out. They don't have any more cards to play, no levers to throw, and no arrows to fire. And they're going to basically be throwing in the towel. This is accelerating a lot of the issues that we already saw happening.
Right. For those retailers that, I guess all of them want to survive, but I mean, would you have any strategic recommendations for the executives at retail companies, I guess, to improve their chances of survival, or to potentially position them better for what we hope will be the eventual rebound?
Well, I think, the thesis that we've put in place several years ago, I think stands regardless. And that is, you have to keep your stores fresh. And we're seeing that right now. Stores matter, and they have mattered for an awfully long time. I think some of the conventional wisdom, I guess, was that, brick and mortar's dead. I can remember when Target followed Walmart about 18 months later and said, we're going to make these investments. We're going to invest in our stores. And people thought, that was crazy. And it turned out to be exactly what you need to do. If someone's going to go to a store, it has to be a positive experience. If someone's going to get me out of my house to go to a brick and mortar location, it's got to be a positive experience, or I'm never going back. The consumer has too many options now. You can buy stuff online from anywhere, and you don't need to visit a physical location to handle your business. So if you get somebody there, and customers are precious in this environment, in any environment, and especially now, those relationships are deep and they need to be mined. I think more targeted advertising on the digital side. Companies were doing that and then they weren't. And I still, my wife and I joke periodically when we go to the mailbox and you need a hand truck to bring all the catalogs in the house. And, why? We're in a world where, just about everybody has a smartphone or a tablet or a PC. Hit them there. If they have my address to send me a catalog, they have the information necessary to send me a targeted ad online. And why not do that? I realize it's, I'm probably oversimplifying, but the reality of that seems to me to be pretty important. Make sure your employees are happy. That's being magnified right now, and you got to take care of them. Retail's competitive. One of the toughest things for a retailer to do is hang on to employees and avoid the classic 100% annual turnover. You got to train people. You don't want people leaving for another 50 cents an hour to walk across the street and work for somebody else. So take care of your employees. Make sure your vendor relationships are solid. Make sure you're transparent with your vendors. All of a sudden, you're not cutting them off or extending terms. Those relationships are important. More collaboration with vendors, with landlords, and that's going to be important going forward. I mean, several years ago, Best Buy had, and this is, one of the positives with a lot of the better retailers, they recognized that their stores were too big. Not that they had too many, but that the footprint of the store was too big. So they took a 55,000 square foot store and cut it to 40. And you walked in the store and you said, this looks better. They lower the sight line so you can see everything from the front door. That kind of stuff. Recognize that the stores matter, they're important, you can leverage them, you can do a lot of different things with a store location. Don't just close them. And we've been saying that for a long time now. The wholesale store closures do not help your business in the long run because they result in decreased online sales. People are more apt to buy online from a brick and mortar retailer if there's a local one where they can return it if they need to. So, you just have to, retail, it's either Lee Scott or Sam Walton at Walmart said retail is not a difficult business at its core. You're buying goods and you're reselling them to the consumer. Keep it simple. You don't need to overcomplicate things, and be very mindful of the stress on a balance sheet. Take care of your capital. Deploy it the right way. You've got to balance it between shareholders, debt holders, and the business. But maybe going forward, more investment in the stores and in technology and in employees is a better use of your money.
Got it. Great insights, Charlie, really. And I loved what you said about the stores. I mean, we're hearing about retailers turning some of their stores into dark stores or turning them into micro fulfillment centers. Mm-hmm. And I love what you said about Best Buy as well, that, you want to focus on the store experience. Thanks again for sharing some time with us, and to all the people watching, everyone stay safe, and thanks so much.
Thank you. You're welcome. And thanks for having me.